every global reserve currency gives off the same warning signs before it dies. Not most of them, all of them. And right now, the US dollar is flashing every single one. This isn't about a red day in the stock market or some scary headline that disappears by next week. This is arithmetic catching up with 80 years of power. It's the moment where the story of this currency will last forever collides with the reality that none of them ever have. In this video, we're going to walk through the four-stage death cycle that killed the Portuguese real, the Dutch guilder, the British pound, and is now wrapping its fingers around the US dollar. Not as fear porn, as a map, because once you see the pattern, you can't unsee it. We grow up assuming the dollar is permanent because it's all we've ever known, but history doesn't care what we grew up with. The Portuguese real had its moment. The Spanish silver pieces ruled the oceans. The Dutch guilder ran global trade. The British pound was so trusted people called it as good as gold. Every one of these was once the obvious, unshakable reserve currency of its time. Every one eventually broke. When historians line them up, the average lifespan of a global reserve currency comes out to roughly one human lifetime, around 90 to 100 years. The dollar's reserve status dates from the mid-1940s. Do the basic math. We are deep into the late stages of the cycle. Statistically speaking, we're no longer in the rise part of the story. We're in the how does this end part. The end of a reserve currency isn't random. It follows a very repeatable four-stage cycle. Stage 1, the rise. Real productivity, trade dominance, surpluses, discipline. Stage 2, the peak. Confidence turns into arrogance. Financialization takes over. Deaths grow but still feel manageable. Stage 3, the decline. War, overreach, deficits, weaponized money, rising interest costs, growing resentment abroad. Stage 4, the collapse. Inflation, default in slow motion, loss of trust, and finally, replacement. Every empire tells itself it's different. The numbers always say otherwise. The brutal part? Most citizens only notice during the last two stages, when their savings quietly bleed out through inflation and devaluation. By then, the elites have usually already moved on to harder assets. Every dominant currency starts with something boring and unsexy: work, manufacturing, trade, real stuff. At the beginning, the rising power is the world's factory and shipping hub. Its ships carry the goods, its factories make the steel, its merchants finance the journeys. People don't accept its money because of blind faith. They accept it because if you want the best goods and technology, you need that country's currency. In this phase, debt is used to build ports, railways, machines, roads. The currency is anchored to production, not dreams. And in that phase, the world is happy to hold it, because holding that currency is like holding a ticket into the most productive engine on Earth. The Dutch didn't stumble into reserve currency status, they engineered it. They built the first real stock exchange, a serious central bank, and a merchant fleet that basically owned the oceans. At one point, Dutch ships carried roughly half of Europe's trade. The guilder wasn't just paper. It was a claim on the most efficient trading machine of its age. When the Dutch faded, the British ran the same play with more horsepower. Coal, steam, steel, railways wrapping around the globe. By the late 1800s, a small, rainy island was producing a ridiculous share of the world's coal and iron. If you wanted rail, ships, or industry, you paid in pounds. Sound as a pound wasn't a slogan. It described a currency backed by dominant industry and real assets.
After World War II, the script repeated, only this time the lead role belonged to the United States. Europe and Japan were in ruins. American factories were intact and humming. The U.S. held the majority of the world's gold and a huge share of global output. So in 1944 at Bretton Woods, the deal was simple. Other countries would link their currencies to the dollar, and the dollar would be linked to gold. If you wanted to rebuild, you needed machinery, food, and technology from America. To get those, you needed dollars. In that first phase, the U.S. was a creditor to the world. It lent, it exported, it built. The dollar's power was grounded in productive capacity and a hard link to gold. That was the honest part of the story. It didn't last.
The second stage feels amazing while it's happening. It's the peak, the glory days. The reserve currency country slowly shifts from making things to financing things. Manufacturing drifts offshore. Services, banks, and stock markets take over the story. The currency is in demand globally, so borrowing becomes cheap and easy. Why sweat in a factory when you can leverage, trade, and consume? Trade surpluses flip to trade deficits. The country imports more than it exports and pays with IOUs that everyone is still happy to accept. On the surface, life looks great. Cheap imports, rising asset prices, booming stock markets. Underneath, the real economy is quietly hollowing out. The nation stops being the workshop of the world and becomes the world's credit card. Once your currency is the global standard, you unlock a dangerous superpower. You can buy real goods from the rest of the world by issuing claims on your own future. The world needs your money for trade, so it accepts your debt at low interest rates. You can run deficits for years without immediate punishment. This is what economists politely call exorbitant privilege. But privilege turns into addiction. Why discipline your budget when you can always roll the debt and print more claims? Why protect your industrial base when finance seems easier? The graphs keep going up. Politicians get reelected. Voters are happy. And almost nobody asks the obvious question: what happens when the rest of the world gets tired of funding this party? That moment is never at the top. It shows up in the next stage. The decline phase usually arrives wearing a uniform. As rivals rise, the dominant power tries to keep its influence. That means overseas bases, alliances, interventions, and operations that never quite end. All of this is paid for with borrowed money. Raising taxes is unpopular. Cutting spending is even worse. So the easy button gets pressed. Issue more debt. Interest payments start to eat more and more of the budget. Eventually, a grotesque milestone arrives. Servicing old debt costs more than funding core national priorities. At that point, the empire faces a choice: accept a smaller role in the world, or keep the appearance of strength by sacrificing the currency. In every historical case, leaders chose to protect the illusion and burn the money. There's another warning sign that always shows up late in the game. The reserve currency stops being neutral. At first, the world uses it simply because it's convenient and trusted. Over time, the issuing country realizes it can use that position as a weapon. Access to the currency and the banking system starts being used to punish rivals and reward allies. Sanctions, freezes, exclusions. Financial tools become geopolitical clubs. In the short term, it looks powerful. In the long term, it's suicidal, because every country watching quietly asks the same question: if it can happen to them, could it happen to us? The more a currency is used as a weapon, the more urgently other nations start building escape routes. When a reserve currency becomes unpredictable or politicized, other nations don't complain loudly. They start building alternatives quietly. They set up parallel payment systems. They sign bilateral trade deals in their own currencies. They experiment with settling energy and commodities without touching the old system. Each individual step looks small. A little more trade in local currencies here, a small alternative network there. But over time, these small exits add up. Trust doesn't collapse in a straight line. It erodes. And once enough critical players feel they no longer need the old reserve system, the shift speeds up brutally. By the time the average citizen hears about de-dollarization on the news, The big decisions have usually already been made in back rooms.
There's one move that central bankers and wealthy insiders repeat in almost every late-stage cycle. They quietly rotate from paper promises into hard assets. For decades, experts mocked gold as old-fashioned, but the data in recent years shows central banks buying more of it than they have in half a century. Not as jewelry, as insurance. Gold has no issuer, no central bank, no board meeting. It can't be sanctioned or defaulted on. That makes it deeply annoying to governments and deeply attractive to anyone worried about currency risk. It's the same story over and over. While the public debates inflation numbers and election slogans, the people who run the system convert a growing slice of their reserves into things that can't be printed.
When a reserve currency reaches the final stage, outright default is politically impossible. So inflation becomes the quiet form of default. The government never sends a letter saying, "We can't pay you back." Instead, it pays you back in money that buys less. The numbers on the screen go up, the purchasing power goes down. Savers feel like they're standing still while doing the right thing. In reality, they're walking down an escalator that's moving the other way. This is how almost every major currency regime ends. Not with a neat announcement, but with a long, grinding theft of time and effort stored in money. By the end, the old currency still technically exists. It just doesn't matter anymore.
So where are we in this cycle with the dollar? We've already seen deindustrialization and the shift to finance. We've seen decades of deficits and ever-rising debt. We've seen military overreach and interventions that outlast public patience. We now live in a world where interest payments on the debt are competing with core national priorities. The currency has been used as a sanction weapon. Rival blocs are explicitly discussing alternatives. Central banks are buying gold. That doesn't mean the dollar disappears tomorrow morning. It does mean the pattern looks disturbingly familiar. Every previous reserve currency told the same story in the last chapters. We're fine. We're different. We're in control. And then the math said otherwise.
Currency collapse doesn't look like an apocalypse movie. It looks like nothing much for a long time. Then suddenly everything is too expensive and nothing works like it used to. First, you get years of low but persistent inflation. People complain but adjust. Then occasional price spikes. Then bigger deficits justified as temporary. At some point, bond markets begin to question whether the math actually adds up. Yields rise, servicing the debt gets harder. More money gets printed to keep the wheels turning. The final acceleration often comes from a shock, a war, an energy crisis, a financial panic, or a major geopolitical fracture. That's when gradually flips into suddenly. By the time most people realize they're in the endgame, the system has already rearranged itself around them. When one reserve currency dies, it doesn't usually vanish overnight and leave a blank space. Something else rises to take its place. Sometimes another single dominant currency, sometimes a more fragmented system. The Portuguese real gave way to Spanish silver. Spanish dominance gave way to the Dutch. The Dutch gave way to the British. The pound gave way to the dollar. Each transition involved turmoil, wars, trade resets, defaults, new institutions. Ordinary people rarely understood the mechanics. They just felt the shock in their savings, wages, and prices. Today, instead of a single obvious successor, we're seeing multiple contenders and experiments. Regional blocks, alternative payment rails, talk of baskets, commodities, and digital settlement layers. On paper, reserve currency transitions sound like charts and treaties. In reality, they feel like your savings not keeping up with rent, your food bill quietly doubling over a decade,
your parents' pension buying less every year. In extreme cases, you see bank restrictions, capital controls, surprise reforms that suddenly convert old money into new at painful rates. The wealthy tend to have lawyers and offshore options. The average family has a checking account and hope. That's why understanding the pattern matters now, not after the headlines arrive. You don't control the cycle, but you do control whether you're standing directly under the falling piano when the ropes finally snap. When currencies weaken, the core lesson across history is simple. Wealth doesn't disappear, it moves. It moves away from paper promises and into things the system can't dilute with a keystroke. That can mean precious metals, land, productive businesses, essential skills, and scarce resources. In every currency reset, people who held nothing but cash and bonds tied to the dying system got crushed. People who held claims on real stuff fared far better. This isn't about one magic asset that fixes everything. It's about flipping your mindset from "how many units of currency do I have?" to "what real claims on actual value do I own?" The more your wealth depends on a single government's promises, the more you are volunteering to be part of the cleanup crew.
The worst position in any currency reset is emotional denial. They'll fix it. They always do. It's fine. That's the soundtrack of people who get blindsided. The opposite extreme, panicking into every doomsday narrative, isn't helpful either. Constant fear just leads to bad decisions. The useful mindset sits between those poles, skeptical, historically aware, calm enough to act, not paralyzed. Ask simple questions. How dependent is my life on one currency? What happens if that currency loses 30 to 50% of its purchasing power over a decade? What part of my savings would I hate to see inflated away? You can't control the empire. You can control whether you personally behave like its most naive creditor. You don't need a PhD to navigate a shaky currency regime. You need a few grounded principles. Avoid being 100% concentrated in any one financial system. Avoid assuming that what worked in the last 40 years will automatically work in the next 20. Value liquidity, but remember that the safest nominal assets are often the first victims of inflation and policy tricks. Diversify not just across stocks, but across types of value. Some hard assets, some productive assets, some cash for flexibility, some skills that translate across borders. History shows that people who spread their risk thoughtfully suffer less when the monetary rug gets pulled. Every empire in history had highly educated people explaining why their situation was unique and safe. The Dutch had sophisticated bankers. The British had the City of London and the global navy. The dollar has technology, markets, and branding. In each case, the experts eventually pointed at charts and models and said, yes, the debt is high, but we understand it. We can manage it. What they couldn't manage was human nature, the temptation to overspend, the refusal to accept limits, the political cost of telling voters no. Whenever you hear, debt doesn't matter anymore, or we can print without consequences because we're special, you're not hearing a new theory, you're hearing the last act of an old play. You don't need inside connections to sense where we are in the cycle. Just keep an eye on a few basic dials. Is total debt growing faster than the underlying economy? Are interest payments consuming a growing share of government revenue? Is the currency being used more often as a political weapon? Are more countries openly talking about alternatives and quietly trading without it? Are central banks buying more gold and fewer long-dated bonds tied to the current system? When too many of those lights turn red at the same time, you're not looking at normal business cycles anymore. You're looking at the late stages of reserve currency life. It's tempting to ask, so what replaces the dollar? Which flag do we salute next? But the next system doesn't have to look like the last one. We're moving through a world with faster communication, digital settlement, programmable money, and many more large economies than after World War II. That points towards something more fragmented: regional hubs, layered payment systems, commodity-linked deals, and maybe some role for digital infrastructure that sits above any single nation. For regular people, the label on the reserve currency matters less than the pattern. Concentrated power, then overreach, then reset. The names change. The mechanism barely does. If you understand the pattern, you won't be shocked by the branding of the next version.
The headline, "The dollar lost reserve status," would be dramatic. But for you, the more important question is, what does my personal balance sheet look like in that world? Currencies come and go. Empires rise and fall. People who adapt early tend to land on their feet. People who assume nothing big ever really changes tend not to. If the dollar slowly bleeds purchasing power over the next decade, that's still a death in practical terms for anyone sitting entirely in cash and fixed promises. If, instead, you've used this time to build skills, diversify value, and understand the pattern, the transition becomes painful, but survivable, maybe even an opportunity. History doesn't ask for your permission before turning the page. It just turns it.
Every reserve currency dies the same way, rising on real production, peaking on privilege and finance, decaying under debt and overreach, ending in inflation and loss of trust. The dollar is not exempt from this pattern. It's simply the latest actor reading the same old script. The warning signs are not subtle anymore. They're baked into the charts, the policies, and the headlines. You can't stop the cycle, but you can decide your role in it. You can be the person who dismisses all of this as noise and hopes to be lucky. Or you can be the person who quietly, calmly, and deliberately rearranges their life so that when the monetary story flips to its next chapter, you are not the one left holding promises nobody can keep. History is loud with examples. The question is whether you treat them as background noise or instruction.